Hi, everybody. Welcome to Friends Talk Money. I'm Pam Kruger, co-host of Money Track on public television and founder of WealthRamp.com.
I'm Richard Eisenberg, a personal finance writer and editor, and formerly the editor of the Money and Work channels for the PBS site for people over 50, nextavenue.org.
And I'm Terry Savage, nationally syndicated personal finance columnist and the author of The Savage Truth on Money.
We're three friends who like to talk money and all the issues that come with it.
On this podcast, we're trying to help you understand your personal finances
to get you and your retirement on the right path for true financial peace of mind.
Well, it's time for Friends Talk Money again. And here's a time we talk about something every year that I really never like to do a story about when I'm reporting. It's tax time. Now, many of you have probably already filed, and good for you for doing that. But if you're one of the millions of people, and there are millions who procrastinate and get it done on the very last day, well, today our Friends Talk Money podcast is going to focus on some helpful ideas and reminders about changes in the tax returns, things that maybe could save you a little money, and probably you might not have noticed them if you haven't started yet. So let me lead off with a few important reminders. Tax filing deadline this year is Tuesday, April 18th. Yes, you can get an extension by filing Form 4868, but this is critical. You must pay all the taxes you owe or face some very stiff penalties. Now, please file your return electronically. Paper is just the day of the dodo. You'll get your refund faster and you will have proof of filing. If your income is under $73,000, you can use the IRS free file system. Just go to irs.gov/free file and you'll be connected with IRS partners who will make filing your return easy. Please set up direct deposit for refunds, not a check in the mail. And while you're at it, double check that you've correctly entered not only your account number, but your bank routing number. And, I hear about this from people every year. It went to an account that we closed. Just make sure that account is still open. And finally, okay, I know I heard all of you saying, I'm going to mail a paper return. At least go to the post office, use certified mail, return receipt requested, and that way you'll know at least they got it. Okay, those are the basics. And if you follow those filing tips, you'll avoid a lot of aggravation and a lot of where's that refund and won't have to go online to figure that out. But now let's move on to some of the bigger questions you're probably asking about this time. And we have some ideas for you. I think I'll lead off. I think the biggest thing you want to know is, where can I find a deduction now? I mean, after all, 2022 is over. Well, let me tell you, there is one good deduction you could still activate if you qualify. You can still contribute to a tax-deductible individual retirement account for 2022 up until the April 18th date that your tax return is due this year. And by the way, that's up to $6,000, or if you're 50 or older, $7,000. But don't wait to open that IRA. That assumes, by the way, you're not covered by a company account. After all the companies like Vanguard and Fidelity and every other place you go is going to be just jammed with last-minute IRA openings so people could get tax deductions. And a couple of reminders. You must have income in order to contribute to an IRA, income from work, not interest income. And if you're also covered by an employer plan, some of you can have a deductible IRA, but it depends on your income level. You get the full deduction if your modified adjusted gross income, I love that word, is $68,000 or less for 2022. And above that, it phases out. And by the way, for next year, you can have a deductible IRA if your income, this 2023 year, if it's below $73,000 in income. And you know what? I just realized something. If we keep giving you all these numbers and single and joint returns, we're going to bore you to death. So we're going to put a lot of that in our show notes and some other tips for resources for getting tax help. And I am now going to turn it over to Richard. Richard, what other ideas do you have for tax deductions?
Well, I'll follow up with what you were just talking about for retirement plans, and that is if you're self-employed, you also have some extra time to set up and fund a solo 401k plan or what's called a SEP IRA plan. I won't go through all the numbers here, but I'll just tell you those are pretty big amounts that you're allowed to put in if you have the money, and you can put an extra if you're 50 or older for those. The other thing I would mention is there's also still time to fund what's called an HSA. That's a health savings account. If you're eligible, you've got an eligible insurance policy. You just have had to have had it since December 1st of last year. And it means you need your deductible is over $1,400 if you're single, or it's over $2,800 for family coverage. If you've got one of these plans, and you probably know if you do, then you can contribute money towards your health expenses. That money grows tax deferred. And then when you take the money out for health expenses, it's going to be tax free as well. So worth looking into those as well.
Okay, and Pam, I see, we look like the Bobbsey twins today. We did not figure out what we were going to wear.
No, I think we did. I think we both knew we were talking about the IRS. We were talking about taxes. So we both looked in black. We had no idea we were both going to wear the same thing.
We had no idea, but we're both serious about this. Okay, what do you want to say about tax season?
Well, first of all, I want to just, on the heels of what Richard just said, listen to me. The HSA is the best thing since sliced bagels. It really is the best plan you could possibly look into it, and without getting into the details, but do look into that if you can.
This is not if you're on Medicare, but if you're still working or self-employed,
especially if you're younger. Yeah, oh my gosh, it's amazing. But let's think about refunds right now, because a lot of people that's what's on their minds. And it's good to remember and remind everybody that a tax refund is a refund, meaning you're just getting your own money back. You either overpaid or you had too much money taken out and withheld for the IRS. And so this is you getting your own money back. So the goal when you're preparing your taxes and filing is to try to come out neutral, so you don't have to wait for a refund. And this year, refunds are smaller, and it doesn't help right now. I mean, we've got inflation going on, and people are going to get smaller, refunds this year. And
I saw that they're going to be on average $300 smaller than last year, and for some people more than $1,000 less than last year, because some people didn't get some of those stimulus checks that they'd gotten the year before, and there are other things that have changed, so it's going to be harder to get those big refunds.
It's the difference between the average refund last year was $2,200. And then this year, people can expect it to be about $1,963. So, there's definitely a difference. And why, what you just said, Richard, remember all those special tax credits and all those breaks that we had due to COVID? So the reason your refund's probably going to be smaller is because those tax breaks that were introduced during the pandemic have now expired. So there were higher tax credits, for example, especially for families with children. So now this tax credit that was as much as $3,000 a year just last year, that same parent can probably expect to claim a possible credit of about $2,000, and it's no longer fully refundable. So these child and dependent care tax credits this year are gonna, they're gonna hurt a lot of people, that they're not as big as they were. And as I say, at the same time as inflation. And so it's the same thing with the child and dependent care credit, which is, again, back to the pre-COVID levels, and it's capped. So just expect that. And if you're on a really moderate income, the earned income tax credit has also been reduced significantly. And then, as Terry touched on with charities, if you make cash donations to your favorite charities this year, instead of being able to deduct the whole amount of your cash donation, this year you're going to be limited to taking about 60% of that. So all said and done, when you see a smaller refund check this year, just know it's mostly due to going back to pre-COVID way of living. So
let me put this up. I know a lot of people are listening to our podcast as opposed to watching it. We're taping now, so you had no idea what Pam and I decided we were dressed alike, but we are. Let me give you just a quick list. That doesn't mean you have to stop driving and write these things down. We'll have them in our show notes. You can always visit friendstalkmoney.org and see our show notes. But let me give you, and the slides that we're going to put up now, let me give you just some things to keep in mind. There's a higher standard deduction this year that benefits you. For the return that you're going to file in April, it's $12,950 for single filers and $25,900 for joint filers and $19,400 for head of households. But guess what? If you're over 65, and I think a lot of our viewers and listeners are, the standard deduction is $1,750 higher than that as single, or $1,400 higher each if you're a married couple. So that will give you a bit of a break on the taxes, a higher standard deduction. There's a higher gift tax exclusion. Remember during the year you say, well, I can give money to my children or grandchildren? It was $16,000 in 2022, but it rises to $17,000, money you can give away without any consequences. Now, it only really becomes consequential later in life if you have an estate that currently well over $12 million that you've given big gifts away. But for most people, it's just sort of comforting to know no forms to file in 2023 if you give away $17,000. Last year was $16,000. And by the way, if you're married, even if you're filing jointly, you can each give that away. So gifts to 529 accounts for grandchildren, etc. Pam, you mentioned it. There is no automatic deduction for charitable contributions. They put that in there during the pandemic. So now you must itemize if you want to take a charitable deduction. And there are a lot of rules around that. You know that. One other thing to think about, did you purchase an appliance or put on solar panels or even buy an electric car? The rules are very complicated about the price of the car, et cetera, and what's deductible. But ask your accountant or tax preparer about the credits you might have earned that could reduce your tax bill. And here's a really interesting one, and it isn't finally resolved. A lot of people worked before the pandemic. They went to an office, they worked in a state, and the state took out state income taxes. The company took out state income taxes out of your paycheck. Then you moved back home to a nearby state or somewhere else where there's no state income tax. So the big question is, do you owe state income taxes if you're still working for a company in a state that taxes income? Talk to your accountant. It is not finally resolved. Well, those are some basics, just things that you might want to keep in mind as you prepare your return. But Richard, I know that you love finding quirks in the tax law, and I know you have a couple for us right now.
Well, there are a couple of things I want to mention. One is for people who went back to school last year, there are now 2 education tax credits left. There are not as many as there used to be. There's something called the Lifetime Learning Credit, and there's something called the American Opportunity Tax Credit. And one of them you can use for graduate school, the other one you can't. It also depends on what your income was as far as how much of that is deductible or you know, whether you're going to qualify for these credits or not. So I'd say if you did take any classes last year, whether it was to, you know, find a new job or get better skills or just go back to school, look those up because it could be that you're going to qualify for something. The other thing, this is very much in the news these days, cryptocurrency. We have our own thoughts about that, but the one thing the IRS wants to know is whether you were involved in buying or selling crypto last year. So there's now a line on your tax return. You're going to see it. They've included NFTs and stable coins, and they basically want to know, you know, were you involved or not? And if you were, you're going to have to report whether you had long or short-term capital gains. And if you had losses, as a lot of people did, that can be useful to offset some gains.
Okay, my head is spinning. Pam, what else do you want to throw into this stew?
Do you guys think that the government could consider giving us a special inflation tax break coming up here? We went from the pandemic to inflation. I just keep thinking about all these breaks.
No, they're not.
I know. I wouldn't even want them to.
Wait, they benefit from inflation because the tax brackets don't go up, but your salary did, you pay more. So no, they're not giving us any good deals on inflation.
Yeah, I know. So we're squished. This year is different. And that's why we're doing this podcast, because it's worth understanding which tax credits that you are entitled to, how to claim those credits and how to get the most out of them. And this year, you're going to get more out of itemizing deductions. So we're going to post an article that's going to help you figure out whether you should take the larger standard deduction now this year, or whether you should itemize. And that's a question that comes into play more this year than before. Even though the average American now pays $240 to get help preparing their taxes, it is not hard to file for free if you're pretty straightforward. So in our show notes, we'll include some resources and some websites that will offer up some good free tax prep help.
All right, so we're back to the IRS. Let me say, as the keeper of the blog on the TerrySavage.com, the Ask Terry blog, I can't tell you how many questions, calls, things people posted because they couldn't get through to the IRS last year. I mean, no one was home. I don't know where all our money went to fund the IRS, but nobody was there answering the phones. They say this year they're going to do better. We're going to hold you to it, IRS. There's no reason you shouldn't have people in the office answering our calls. And it's about time you caught up. And they told me that they are caught up on 2020 and 2021. One of the things they don't like to tell you, because they're phasing it out, is there's a feature, and you cannot find it by searching the IRS website, called opening an ID me account. Initials ID, like identity, .me. And if you go to terrysavage.com, I never tout my own website, but nothing gets sold on my website. There are no ads, nothing like that. Under financial links, it says open an IRS ID me account. If you set up that account, you can get right through. It's like looking over the, did you ever want to look over the screen when the airline reservation is just, telling you what seat you're going to have and all that? This is like looking into the IRS pretty much computer, and you can find out things like, there's also where's my refund, that you can find out what the situation is with your own account. So use the link at terrysavage.com under financial links to open an IRS ID me account. Richard, any other thoughts on or tips for this year's tax filing?
Well, I would like to offer my condolences to people for the pain that they may endure when they're doing their tax return and they see that they're going to owe taxes on their investments last year when their investments lost money last year. It doesn't seem like that should be true, and yet it is. A lot of people with money in mutual funds and ETFs last year are going to owe capital gains taxes because their funds sold some shares, sometimes because people were trying to get out, or sometimes because they just wanted to sell some shares. And so even though you lost money, you're going to owe taxes as though you didn't lose money. And I think that's sort of too bad, but unfortunately, a lot of us are going to be facing that.
Yeah, they distribute the capital gains, even though the value of the shares, the fund shares, went down. That's a great argument, Richard, for index funds, which don't tend to do that. Pam, any other thoughts before we close?
Yeah, with that in mind, all I can say is that I try to stay in a good mood. Nobody likes to pay taxes. I try to stay in a good mood during tax season. I even tried paying my taxes with a smile, but they still demanded money.
Yeah, I don't think even your lovely smile is going to be a way out of taxes. It was Ben Franklin who said, nothing is certain but death and taxes. Actually, I think taxes are very uncertain. As we talk, Congress is again discussing how they could potentially change the tax laws. You think, Richard, it was bad that they taxed gains that were distributed, even though the fund shares went down? Now they want to tax, for some anyway, capital gains that haven't even been taken yet. Our tax system overall is obviously very political. Both sides of the aisle are fighting it out right now. But on a personal side, you don't want to get in a fight with the IRS. So again, check our show notes. We're going to have some tips where you can get help. Do not panic. Do not leave it till the last minute. Make sure that at the very least, you choose maybe one of the online tax preparers that also offer personal help. And now that you've watched our podcast, do it. That's our last word of advice. Do not procrastinate one more minute. We'll see you next time on Friends Talk Money.
Bye. Thanks.
Bye. Friends Talk Money is funded in part by a grant from the Investor Protection Trust. The IPT is a nonprofit organization devoted to investor education. Since 1993, the IPT has worked with the states to provide the independent, objective investor education needed by all Americans to make informed investment decisions. Visit investorprotection.org. We also receive support from the North American Securities Administrators Association, known as NASA. It's the oldest international investor protection organization. NASA's members include state and provincial securities regulators from the U.S., Canada, and Mexico who serve on the front lines of investor protection. Recognizing that education and awareness are powerful tools in the fight against investment fraud, NASA is pleased to sponsor Friends Talk Money. Here are 3 important tips to help you protect your money from fraud. With investing, there are always risks, so be cautious of anybody telling you that a certain investment is guaranteed. You should also proceed with caution if somebody is promising very large investment returns. This is a common red flag for investment fraud. Last and most importantly, be sure you're working with a licensed or registered financial professional. You can check your advisor and make sure they're licensed by visiting brokercheck.finra.org. NASA is your partner in keeping you safe and helping you avoid investment frauds. Visit nasa.org and click on the Investor Education tab to learn more.